So today we're doing a deep dive into Tesla financials, and this might be the most uninteresting thing that you could have clicked on because if you're invested in Tesla, it's highly likely that none of us are interested in Tesla's current financials because, to be frank, they are quite grim. And most of us are not invested in Tesla for the $6,700 in profit that they make on every vehicle they sell right now. Because if we were, we'd be paying a very, very expensive price for that business. All of us are invested for what Tesla's business is going to become, and we all have the foresight to see what it is going to become. But I'm telling you right now, there is value in getting into the nitty-gritty of these numbers.
Bang, bang, bang.
We're getting high frequency today, and Nvidia did not start to moon until analysts started to see the income statements doubling on top of each other over and over and over again. It wasn't until the earnings growth was evident in these financial reports that Nvidia started to play catch up. So we got to stay grounded in the numbers. We got to try and see what the bears see. Let's put ourselves in the bears' shoes so that we can better understand their position so as to better counter it. I also think that the market is not going to wait for the earnings growth to start doubling and the statements for Tesla stock to start to really take off. I think it's going to happen much faster than it did with Nvidia because it already happened with Nvidia and people don't want to miss out again. And number two, there's a lot more eyes and ears on Tesla now than there was on Nvidia then. The adoption of autonomous vehicles is a much more obvious growth curve to wrap your head around than GPUs were. The demand for GPUs was a bit harder to map out than autonomous vehicle adoption is. So AJ, the creator of these slides, a great financial analyst, is going to help us wrap our heads around Tesla's numbers now so that when things start to change, we're the first ones on the scene. So we've got 36 slides to get through, so I'm going to keep this at a fast pace. Total revenue decreased 9.2% year on year to $19.3 billion, marking an 11-quarter low driven by the auto segment, which saw both 50,000 fewer vehicle sales compared to the first quarter of 2024. This is due to the concurrent global new Model Y changeover. And this is the lowest vehicle deliveries in a quarter since the third quarter of 2022. Now, there's also a reduction in the average selling price of 7.4% or $3,200 year on year. However, thanks to the new Model Y, the average selling price increased sequentially from $39,800 to $40,300, an increase of $500 per share. And that's the first time that the ASP has increased since the fourth quarter of 2022. So the net result of the lower vehicle volume and the lower average selling price was a year-on-year auto sales decrease of 21.5% to $12.9 billion, marking a 14-quarter low, and the Model Y changeover was the primary driver of this. On the bright side, regulatory credit sales increased 35% year on year to $595 million. And the pure profit nature of regulatory credits makes $600 million as valuable as 131,000 Tesla vehicle sales. And while that's a lot of vehicles, the $595 million was actually a 4-quarter low. And I have been hearing a lot of people wondering if regulatory credits in the United States are going to go away. But one really interesting thing to note is that Tesla collects regulatory credits from all major markets, the US, China, and Europe, and thus a potential reduction or elimination under the current US administration would drive only a partial loss of up to a third of the regulatory credits. And the forecast reflects net effects of legacy leasing book runoff and recent increase in promotional leasing sales. So you can see Tesla's leasing revenue has been flat for the last 3 quarters, and this is a bit odd because the leasing fleet continues to increase, but we're not seeing that growth. It's being offset by the fact that Tesla continues to offer really attractive leasing offers. We also saw total automotive revenue, including leasing and credits, decreasing 19.6% year over year to $14 billion, marking a 14-quarter low. And again, the Model Y changeover represents the primary driver of this. It's the most sold vehicle in the world, so it's clearly going to have some effects. But a very interesting thing to compare is the flatness of Tesla's automotive revenue compared to the growth seen in Tesla's energy generation and storage revenue. Revenue in the energy segment increased 67% year over year to $2.7 billion. And this was driven by energy storage deployments growing 157% year over year to 10.4 gigawatt hours, with partial offset from a 32% year on year reduction in average revenue per kilowatt hour deployed to $243 versus the prior year of $356. So what this means is that there's other competitors now in the energy storage deployment industry because the revenue per kilowatt hour that Tesla can get for their energy storage is dropping. But what's really impressive, as we'll see later when we look at the energy storage profits, is that Tesla is maintaining their almost 30% margins. They got a 28% energy storage profit margin this quarter, which suggests that their cost of goods sold is also dropping on their megapacks. Now, Tesla's service and other segments saw for the first time a sequential revenue decrease, decreasing 7% to 2.6 billion. However, services and other revenue is up 15% year on year. But that's pretty staggering. For the first time ever, a sequential revenue decrease on services and other. So now we're going to move from revenue into profit, and total gross profit decreased year on year 15% to 3.1 billion, marking a 15-quarter low. This was driven by the auto segment decreasing to an 18-quarter low of 2.19 billion. The energy segment's year-on-year gross profit doubling was insufficient to offset the loss in the auto gross profit. And you can see that the energy segment's profit now makes up almost a third of all of Tesla's profits. If you go back to the first quarter of 2022, you can see that the energy segment made up none of Tesla's profit. And so this is one of the reasons I think it's important to take a look at these charts. Elon would say to everyone that the energy storage business is going to be a big and meaningful business for Tesla. And a lot of bears wrote him off and they did not believe him. And now we are seeing that happen before our eyes. And if you link it to what Elon is saying about robotaxi and how that's going to dwarf Tesla's current businesses, the bears laugh him off. Well, he did it with energy, so why can't he do it with robotaxi? Now, here's probably the most staggering slide yet. Auto gross margin decreased to 11.3% excluding credits, a year-on-year decrease of 4.2%, marking an all-time low. Tesla, going all the way back to the IPO, has never had auto gross margins this low. In just 3 years, the auto gross margin has dropped almost 20%. However, if you bake in leasing and regulatory credits, the auto gross margin looks a little bit healthier. It decreased to 16.2%, which is a year-on-year decrease of 2.2%, but it also marks the lowest level since Tesla's IPO in 2010. However, the decrease is only 16%, which compares to about an 18% decrease for the auto gross margin excluding the credits. So the credits are still padding Tesla's auto gross margin and the credits aren't going anywhere. So I don't think it's right for analysts to write off those credits. So in total, Tesla's all in, including leasing and regulatory credit sales, gross profit per vehicle decreased year on year by 18.8%. And increased relative to last quarter by 1.5% to $6,730 per vehicle. Now, on the flip side of this, energy generation and storage segment delivered the second highest ever reported gross margin at 28.8%, improving year on year 4.1% and quarter over quarter 3.5%. This marks the second highest ever reported energy and storage gross margin. And in services and other, the gross margin increased year on year, but experienced a 0.3% decrease quarter over quarter. Now, for total GAAP gross margin across all of Tesla's businesses decreased year over year by 1% to 16.3%, marking a 23-quarter low. It's the lowest total gross margin for Tesla since the second quarter of 2019. Now, we're talking a lot about falling gross margins, but operating expenses increased 9.1% year on year to the second highest ever reported quarterly spend at $2.7 billion. And just by looking at the chart, Tesla's spending about $1 billion more per quarter on things like AI-related initiatives. On the first quarter earnings call, the CFO said that for 2025, we expect operating expenses to increase to support our growth initiatives. And so with growing operating expenses, that means growing research and development expenses. They were at an all-time high of $1.4 billion, increasing 22.4% year over year. Tesla is spending pretty much double what they used to spend on R&D in 2022. And so while we've seen the auto gross margins get absolutely hammered over the last few years, you can see that their operating expenses, their R&D, their marketing efforts and the referral program, these are some of the things that are hurting that auto gross margin, not to mention the price cuts. But even selling general and administrative expenses are significantly higher. They did reduce 9% year over year thanks to that big headcount reduction that we got in the second quarter of 2024. And they dropped this quarter to 1.2 billion, providing some offset to the quickly growing R&D spending. And here's another reason for the high OPEX this quarter: a 5% year-on-year increase in share-based compensation for a record high relative to earnings. So the Tesla board and Tesla employees received $428 million worth of Tesla stock-based compensation this quarter. And it's interesting how the stock-based compensation dilutes your ownership of Tesla, because a few years ago I calculated for how many seconds per year I own Tesla. And over the last couple of years, even in that time frame where I did not buy stock, the number of seconds that I owned Tesla dropped because of the stock-based compensation. And something that's really interesting this quarter is Tesla allocated nearly half of all of its stock-based compensation to research and development accounts. So Tesla is allocating more and more resources to research and development. And I think this will pay off big time in the AI race. But in addition to increased R&D spend, restructuring charges of $94 million increased Tesla's first quarter operating expenses and marks a continuation of a 4-quarter-long restructuring effort and is atypical for Tesla. This suggests management is reshaping the company for either a different setup, slower growth, or is battling down the hatches before an anticipated storm. Operating profit decreased 66% year over year to $400 million due to lower auto gross profit and increased operating expenses from R&D spend. This marks a 19-quarter low in operating profit, the lowest since the second quarter of 2020, which was the COVID quarter. The operating margin, excluding restructuring charges, decreased to 2.5%, marking a 23-quarter low. And again, the loss of vehicle volume due to the Model Y changeover was the primary driver. But speaking of $400 million, interest income was Tesla's primary source of profits in the first quarter 2025. Interest income on Tesla's over $35 billion cash pile accounted for 67.9% of Tesla's profit before tax. And interest expenses decreased $5 million to $91 million, driven by reducing cost of debt. Other items created a headwind, however. After creating a major tailwind in the fourth quarter, Tesla's Bitcoin holding drove a $97 million mark-to-market loss, and the profit before tax decreased to $589 million, implying a 4-year low. But then they get taxed at a record high of 28.7%. However, the increased implied effective tax rate is the result of the low profit before tax number, which includes non-taxable deductibles. So Tesla's income tax reduced to $169 million, which was $240 million lower than the $409 million they paid the year before, but that was driven by lower taxable income. And even the shareholders' net income was at an 18-quarter low. It dropped 64% year over year to $409 million. And the diluted number of shares outstanding continues to rise 1% year over year, or 37 million brand new Tesla shares in the last year. And finally, the big number that Wall Street always watches for: earnings per share decreased year over year 41% to 26 cents, marking a 4-year low for Tesla. And if you told me that Tesla would post a 4-year low in EPS and the stock would rise 25% after they posted those earnings, I would not have believed you. And I'm not going to sit here and try to hypothesize why it went up 25% that week, but I think it's pretty crystal clear that a huge chunk of Tesla's valuation has to do with what's coming in the next year, whether it's more affordable models, whether it's the energy storage generation profits continuing to ramp as new factories come online, or whether it's the Cybercab getting deployed in Austin in a couple of weeks and starting to get scaled. These are the things that is keeping Tesla at a market cap of $917 billion, despite the fact that it was almost unprofitable this quarter. And of course, there was a Model Y changeover and a legion of idiots trying to set Teslas on fire. But that was definitely a quarter to forget. And I think what we're seeing with Tesla stock over the last couple of years and going into this year is that the floor has risen. I think if it was a few years ago and we went through some of the things that Tesla has had to go through in the last couple of months, we would not be anywhere near $284. I think we'd be closer to $100 a couple years ago, and I think that's just because the floor for Tesla has risen. And I think that's a direct result of the improvement in Tesla's tech over the last couple of years. I think the writing is on the wall at this point, and I do think a big portion of Tesla's market cap reflects that. But I also think that the earnings that this tech that I'm talking about, whether it's Optimus or FSD, the money that those technologies are going to generate is going to exceed the multiple that is currently baked into the stock. And to bring it back to the discussion around NVIDIA that I started this video with, I don't think that Wall Street and the big whales are going to wait until Tesla's earnings growth is doubling year on year over multiple quarters to get into the stock, because I think that the opportunity this time around is much more obvious than trying to predict what happened with NVIDIA. So I'm not going to be on the sidelines for this revolution and for this dramatic change. We've been in between growth waves, and we saw what happened to the stock when we hit Tesla's first growth wave with the Model 3 and the Model Y. And so I'm definitely not going to miss the second growth wave. I was on board for the first growth wave somehow. It was with very little money, but I was on board. This time, I'm going to have everything in the pot. So I really hope you guys enjoyed this deep dive. Make sure you're following AJ. He's the one who did this analysis. He does really, really good work. I recommend subscribing to him. I'm subscribed to him on X. So I got these charts weeks ago, but I have to wait until he makes it public so that I can make a video about it. Anyways, guys, I'll see you guys in tomorrow's video, and have a good night.